6 NBFCs play a huge role in Indian economy. Discuss. Also comment on whether India needs to implement the idea of wholesale banks in the situation NBFCs find themselves today. 250 words background. Non-banking financial companies (NBFC) are establishments that provide financial services and banking facilities without meeting the legal definition of a bank. They are covered under the banking regulations laid down by the Reserve Bank of India and provide banking services like loans, credit facilities, TFCs, retirement planning, investing and stocking in money market. However, they are restricted from taking any form of deposits from the general public. Some of the examples of NBFC in India are Bajaj Finance, Mahindra and Mahindra Financial Services, etc. Recently, Indian non-banking financial companies (NBFCs), especially housing finance companies, have witnessed a fall in valuations and rising bond yields. Liquidity for NBFCs has also significantly contracted across the board. Role of NBFC in Indian economy. Profitability. NBFCs are more profitable than the banking sector because of lower costs. This helps them offer cheaper loans to customers. As a result, NBFCs' credit growth is higher than that of the banking sector, with more customers opting for NBFCs. Infrastructure lending. NBFCs contribute largely to the economy by lending to infrastructure projects, which are very important to a developing country like India. Since they require large amount of funds and earn profits only over a longer time frame, these are riskier projects and deters banks from lending. Promoting inclusive growth. NBFCs cater to a wide variety of customers both in urban and rural areas. They finance projects of small-scale companies, which is important for the growth in rural areas. They also provide small-ticket loans for affordable housing projects. All these help promote inclusive growth in the country. Variety of sectors. NBFCs are beginning to meet the consequent unmet demand for credit across a variety of sectors and ensuring continuing credit flows to the real economy. NBFCs have been maintaining low net NPA ratios of 3.5%, unlike their banking sector counterparts. NBFCs have been found to be relatively more resilient to stress applied for credit risk, as observed by the RBI in its financial stability reports of the past 2 years. NBFCs, even under severe stress conditions, continued to remain stable. NBFCs have been able to complement the credit intermediation by banks by serving regions, sectors and customer segments that banks have either been unable or unwilling to serve profitably. NBFCs often take lead role in providing innovative financial services to micro, small, and medium enterprises (MSMEs) most suitable to their business requirements. NBFCs do play a critical role in participating in the development of an economy by providing a fillip to transportation, employment generation, wealth creation, bank credit in rural segments, and to support financially weaker sections of the society. Emergency services like financial assistance and guidance is also provided to the customers in the matters pertaining to insurance. NBFCs aid economic development in the following ways. Mobilization of resources. It converts savings into investments. Capital formation. Aids to increase capital stock of a company. Provision of long-term credit and specialized credit aid in employment generation. Help in development of financial markets. Helps in attracting foreign grants. Helps in breaking vicious circle of poverty by serving as government's instrument. Wholesale banks. Wholesale bank licensing for India. An idea first floated by the RBI Committee for Comprehensive Financial Services for Small Businesses and Low-Income Households in 2014. The committee envisaged these licensees to be like universal banks on their asset side, with freedom to originate a variety of assets, but with important differences for their liability side. Wholesale banking involves providing banking services to other commercial banks, mortgage brokers, large corporate, mid-sized companies, real estate developers, international trading businesses, institutional customers, or other corporations. The services which come under the net of wholesale banking involves wholesaling, underwriting, market making, consultancy, mergers and acquisitions, joint ventures, fund management, etc. The focus is on high-level clients and high-value transactions. Why India needs to implement this idea. Transition to wholesale banks would ensure that NBFCs now have a more permanent and stable way of dealing with their funding problems. With this, the RBI can get a better grip over potential contagion risks while supporting the banking system on its slow path to recovery. India presents a strong case for the growth of wholesale banking due to continued globalization of Indian companies, India being seen as a favorable investment destination, increase in infrastructure spending, stable government, robust markets, stable currency, low deficits. Wholesale banking thus comprises a major share of the banking revenues due to the above factors, and also due to an increased inclination of government towards mid-segment companies which have increasing banking requirements. The major advantage in wholesale banking is that a client can have easy and one-place access to all its finances and their details. This makes internal stock transfers, fund transfers, allocations and distributions simpler. These would help take out pressures from existing commercial banks that are averse to fund long-term projects due to heavy bad debts in their books. Also, niche banks can bring expertise to the banking system that could lead to enhanced efficiency in terms of reduced intermediation cost, better price, and improved allocation of capital. Commercial banks, including NBFCs, have preferred to lend to the retail segment where the delinquency rates are low. Therefore, having banks which focus on only long-term lending will be very useful and add a new dimension to lending as banks continue to focus on short-term lending. The demand for funds is high, given investment rate is quite low at 27%. If it has to be pushed up to 35%, alternative avenues need to be sourced as banks, ECBs, and the debt market have their limitations. This new genre of banks will definitely add value. Concerns. However, these banks increases the risk it poses to the clients as all their funds are parked in one institution and the businesses depend on the financial health of the bank for smooth run. In cases of economic downturns, if the banks crash, all the dependent businesses come to a standstill instantly. Skepticism on wholesale banks being viable comes from the fact that similar institutions dotted the landscape not long ago. They not only became unviable due to their structure, but also became a drag on the whole system for years. Way forward. For wholesale banks to succeed, several options need to be explored. The first issue is how to lower the spreads for the WLTF bonds. Having bricks and mortar structures would add to costs, and hence the option of being primarily an internet-based bank can be considered second. The wholesale banks can be made to apportion lending activity across both credit and debt markets. A 50-50 division will be useful as they can lend directly in the bond market for bonds which will be higher rated. This will also be the preferred route for higher rated companies. The balance lending should be based on collateral with insolvency laws in place. Also, RBI should focus simultaneously on credit enhancements to be provided by banks on such bonds which may be subscribed by the WLTFs. Third, the wholesale banks should be freed completely from CRR and SLR obligations. The CRR is a disincentive while SLR will make them gravitate towards GSCCs. Fourth, RBI can set tenures for their lending, i.e., not less than 5 years for such a norm, but should give the freedom to lend to any sector. Bringing in priority sector-like norms will impede